Welcome back. We're going to talk about how to pay off a home early. Now, this is a misconception for a lot of Americans, and in this episode, I'm going to empower you how to get out of debt, whatever your definition is of out of debt, probably 2 to 3 years faster than any method of sending extra principal payments against your mortgage. Did you hear that? This will get you out of debt quicker and help you become more financially independent quicker than just sending extra principal against a mortgage. So I'm going to empower you with some specific action steps that if you're self-disciplined, you will accumulate far more money using this method than just sending money against the mortgage. So I'm Doug Andrew, and I've helped literally thousands of people get out of debt quicker, pay off their home mortgage faster, but they're shocked when I show them how to do it without sending extra principal payments against their mortgage. See, the obstacle that we have to overcome is realizing that mortgage interest, for example, is not your foe. It actually is your friend. This is how money works, and I'm going to empower you how you can become your own banker and get out of debt 2 or 3 years faster than sending that money to the mortgage company. Because every time you write out a check for an extra $100 against your mortgage, you're in essence saying, "Here, Mr. Mortgage Banker, is an extra $100 this month. Don't pay me any interest on this. If I want this money back, I'll borrow it back on your terms and prove there's a need why I should have it." Sounds sort of stupid, doesn't it? Okay. So let me tell you a story. One day I met with 3 finance professors at a major university, and they were teaching their advanced 400 classes, and they said, "You know, Mr. Andrew, we teach all of our finance students here that when they go out and purchase their first home, they ought to try to qualify and take out a 15-year amortized mortgage instead of a 30-year amortized mortgage." I looked at them and I said, "Really? Why do you do that?" And they looked at me like, "Duh." Maybe they meant Doug. I don't know. But they said, if you'll just bite the bullet and pay extra principal against the mortgage, a little bit higher mortgage payment, you'll save a grundle of interest, and you'll have your house paid off in 15 years instead of 30 years. And now you can set aside that difference into a tax-deferred investment like an IRA or 401k, and you'll end up with this much money. I said, "Gentlemen, you're finance professors. Haven't you ever taken the differential between a 15-year amortized mortgage payment, let's say of this, and a 30-year amortized mortgage payment, which is less? Take that difference and don't spend it. Use a system to set it aside, plus the tax savings you will achieve during the first 15 years of a 30-year mortgage versus a 15-year mortgage. Take that difference and sock it away and put it over here on the side into an account earning compound interest, and I preferred tax-free." Of course, they said, "What's tax-free?" So I had to tell them about my favorite instrument, which I cover in other episodes. I call it the laser fund. I said, "Do you understand compound interest and how money works?" "Yes." I said, "Well, how do banks and credit unions make money?" "They borrow our money at 1 or 2%. So every million they borrow from us, they pay 10,000 or 20,000 in interest. But what do they do with our money? They don't put it in the vault. They turn around and invest it or loan it back to us at 5 or 6%. So they're earning 60,000 on that million. They're only paying us 10 or 20,000. How much more is 60,000 than 20,000? Don't say 40,000. No, it's 300%. Let me put it this way. Would you hire an employee for 20,000 that made you an extra 60,000? Would you buy a widget machine for $20,000 that made you an extra $60,000? Well, any business owner knows that. That is a 300% return on employment costs or equipment costs. By learning how money works, you can become your own banker. So I showed these finance professors on an HP 12C calculator. I said, let's do this equation, because they'd never done the math before. And by taking the differential between the 30-year amortized mortgage payment, okay, which was the lower payment, and the 15-year, plus the tax savings, which we calculated, and I put it over here compounding at an interest rate that was double or triple the net cost after the tax deduction of a mortgage, okay, because you can deduct the mortgage interest on a personal residence or even on a non-owner occupied rental income property. I take the net. So if I'm borrowing on a mortgage at 3%, in a 33% bracket, it's only costing me 2%. A third of that I'm saving in tax. If I borrow at 6, it's only a net cost of 4. So if I'm paying a net of 4% on my mortgage, but I'm earning 8% over here on the money I was going to give the mortgage company, I'm making 100% more than the cost. They were flabbergasted. There was enough money over here in this side fund to totally pay off the 30-year mortgage in 12 and a half years. Using the same money, they were telling their students to apply against the mortgage by a higher mortgage payment in a 15-year mortgage. I said, look, I can get them out of debt 2.5 years faster. On a $300,000 mortgage, that was $50,000 extra dollars that I was able to create for somebody using the 30-year mortgage and using a side fund versus their method of giving it to the mortgage company, killing their partner, okay, their friend, the Uncle Sam, because you can deduct that mortgage interest. And so they were like, whoa. Now, you do have to be disciplined to be able to do this. But if you want to get out of debt faster and you set it aside over here, you'll have enough money to pay off your mortgage probably 2 or 3 years sooner than any method of sending extra principal payments to the mortgage company. Let me tell you why that's important. So I've written about a dozen books, and in almost every book I talk about this topic. In my very first book, I called it the $25,000 mistake being made by millions of Americans because they're missing out on 25 grand. That was on a $150,000 mortgage. I just mentioned on a $300,000 mortgage, it's a $50,000 mistake. If you're listening to me right now or watching this episode and you're going, oh, I have a $600,000 15-year mortgage, or I'm sending extra principal payments to the mortgage company to get out of debt in 15 years, that's a $100,000 mistake, in my opinion. You're kissing 100 grand down the drain. Now, other than that, I don't have any strong feelings on this subject, but this is real money, folks. So I learned this lesson the hard way. Clear back in 1978, my wife and I built this beautiful 6,400 square foot, 6-bedroom home with cathedral beam wood deck ceilings. We thought we had the world by the tail because we had all this equity. We built it for $150,000 back in 1978, and it appraised for $300,000 when we finished. Well, we had some things that happened to us that happened to everybody. We had setbacks. In 1980, in Houston, Texas, during the energy crisis, 16,000 homeowners lost their homes in foreclosure. 16,000 homeowners didn't all of a sudden become bad people. They just couldn't make their mortgage payment. Some of them said, I've been sending $100 a month against my mortgage, okay? And then they lost their job or they got sick or disabled and they go, oh, wow, I should be way ahead. They went to borrow that back. Now, if you haven't noticed, lenders don't loan you money based upon your collateral. They will tie up your collateral, your house. They loan you money based upon your ability to repay. If you lose the ability to repay, they're not going to loan you the money. Unfortunately, I have seen thousands of people who were sending extra principal payments against their mortgage the wrong way, and when they lost their job or they got disabled, they could not access that, and they watched it in 2008. Many people had been doing that. They lost every dime. Their house went down in value. What I learned back in 1982 is that My home, okay, did not pass the liquidity and safety and rate of return test, which I explain in other episodes are the key elements of a prudent investment. Unfortunately, I could not access that equity. It was just a number on a sheet of paper a few years earlier. By not sending extra principal payments to the mortgage company, we were able to go out and be empowered so that on any piece of real estate, I kept my hard-earned equity separate from the property, earning compound interest where it was liquid, safe, earning a predictable rate of return. And any time with an electronic funds transfer or phone call, I could access that money instead of having to borrow it back from the mortgage company. I'm out of debt quicker if I want to accumulate the money and pay it off, but I'm in control, not the mortgage company. The key takeaway here is that if you want to get out of debt quick, you want to get your house paid off, it's not any way, shape, or form sending extra principal payments to the mortgage company because you're giving up the access, the liquidity to that. If the house goes down in value, you didn't have safety of principal. If it's parked over in a safe place, you have that safety. And you're earning rates of return often that are double, even triple the net cost of the mortgage, and this is how banks and credit unions make money. They're conservative, but this is how you can become your own banker and get out of debt quicker. Now, this is a lot to swallow for many people. So I would encourage you to explore and learn, watch a lot of our other educational episodes to understand how you can use this to harness the value of these miracles, these marvels of wealth accumulation. So the key takeaways I want for you to empower you is to not make the $50,000 or $100,000 mistake being made by fellow Americans who think that the best way to get the mortgage paid off is sending extra principal payments to the mortgage company. Learn how to set aside the money in a conservative side fund, compounding tax-free at a higher rate than the net cost of the mortgage, and you will get out of debt quicker and faster, but you'll maintain liquidity if you need the money, safety if the value of your house goes down, and you'll earn more safe, predictable rates of return. And if the house appreciates, that's just icing on the cake. But you're in control. I really want you to understand how I learned this lesson. I have my story. It's called My Defining Moment. Click here and you can view my story and how I learned these valuable lessons. And also below, you can click on any of these other resources because I usually share these insights in my various books and educational materials.